House prices have now fallen in over 98 different cities across America, according to John Burns Real Estate Consulting, as this housing correction continues to spread nationwide. Now, we've been seeing this downtrend continue to get worse as mortgage rates continue to skyrocket and affordability continues to plummet, forcing more home buyers out of the market. Now, inflation also just came back worse than expected, and so how we end up tackling that is going to play a huge role in just how bad this housing correction ends up getting. So lots to discuss today, and we're also going to be taking a look at some of the cities that are seeing the biggest declines in home values right now, along with some cities that are still seeming like they're on the way up. But before I get started, do me a favor and support the channel by smashing that like button, and if you haven't already done so, definitely subscribe and hit that notification bell to watch more content like this. And with that said, let's jump into it. Fortune magazine just came out with an article talking about how 98 of the major housing markets are experiencing a decline in home values from the peak. Now, this is an interesting article because there's actually more than 98 cities that have seen price declines across the nation if you look at data from Redfin or you look at data from Realtor.com, but this particular information comes from John Burns Real Estate Consulting. Now, for those not familiar, John Burns Real Estate Consulting provides some amazing analysis on the housing market as a whole, and rather than focusing just purely on the median sales price in its raw form, they put together an entire home value index. So essentially what they do in a nutshell is they take other factors into consideration in addition to what the median sales price is doing in order to truly determine what the house values are doing in a particular area. One example of that would be taking into account something like seasonality. For instance, it's very common to see house prices dip slightly during the winter since there's less home buyers looking to buy a house during that time. Now, on a typical chart showing the median sales price, you're going to see the volatility taking place, the ups and downs that take place along the way. Whereas with the Burns Home Value Index, it smooths it out to show more of the overall trend of what's taking place. So in plain English, it just makes it easier to determine the overall direction the housing market is heading. So if you take a look at back in the 2007 crash when that took place, you can see the gray line here is the median price point, and you can see it fluctuates up and down along the way as it climbs up back in 2004, 2005 as we're reaching the peak. And even when we're at the peak, you're seeing ups and downs, and it can be hard to identify when the downtrend is currently taking place. Now, the blue line, that is the Burns Home Value Index, and you can see it's more smoothed out, showing you where the true accurate peak of the market is. And as it continues to decline, you can see there was a bit of a false bottom that took place with the median price, whereas the true bottom with the Burns Home Value Index, you can see it really took place around mid-2011. So Burns Consulting said that out of 148 major regional housing markets, that 98 of them have seen a decline in home value since the peak levels. Now, of those 98 cities, 11 of them have seen over a 5% decline in home values. Now, out of these 11 cities that are seeing declines of over 5%, the majority of these cities actually fall in California. If you take a look at this interactive map they put together, you can see that San Francisco, San Jose, they're all around 8.2% in decline of home value. You have Ventura here at 6.9% decline. You have LA, Orange County, San Diego, all around the mid fives. And really outside of California, the only place really seeing a significant decline on par with those California cities would be the city of Seattle, Washington. And you see over here, Seattle seeing declines of about 7.8%. Now, it's completely normal that these markets would feel the pain first because these are some of the higher price points throughout America. And when you throw in the fact that mortgage rates have gone up all the way to the sixes is where we're currently at right now, you're going to see that affordability starts to plummet, especially in the areas that have these extremely high price points. Now, in the next tier down, you're going to run into a lot of these pandemic boom towns where everybody was migrating to during the pandemic. You can see here on the map, you got Reno, Nevada, 5.3%, Phoenix around 5% here in declines. You also got Austin, Texas around 3.5%, Boise, Idaho 3.5%. You also got Las Vegas at around 3%. Now, some other markets that are standing out on this map, you got Nashville sitting at about 4.7%, Fayetteville, Arkansas, Houston's at about 4.5%, and Spokane, Washington at about 4.7%. So those are some other markets also feeling feeling the effects of a decline in home values. Now, Rick Palacios, who is the director of research for John Burns Real Estate Consulting, said the following about this. He said, "Our view is that you will see, and we're seeing it right now, home prices will fall even though supply levels are not ripping higher." And I think that's an interesting thing that is now starting to surprise a lot of people. Now, my thoughts on that is that I definitely agree that home prices will fall, although I do believe we're not going to come into this situation where supply levels will not get higher than they are right now. I do believe that buyer demand is going to continue to fall as affordability continues to get worse. We see these mortgage interest rates rise. We see affordability continue to plummet. We see an economic recession take place. We see the unemployment level starts to rise. All of that is going to have an effect on buyers exiting the housing market, and I do believe as a result of that, we will continue to see these supply levels get higher over time. Now, he also went on to say that the longer that mortgage rates stay elevated, our view is that housing is going to continue to feel it and have this reset mode. And the affordability resetting mechanism right now that has to happen is on home prices. And so there are a lot of markets across the country where we're forecasting that home prices are going to fall double digits. Now, I completely agree with him here, and I do believe that mortgage rates are at the center of all of this right now, because with mortgage rates affects affordability, and affordability, as it continues to go down for the average American, we're going to see prices continue to plummet. And I do believe that in many cities across America, we're going to continue to see double-digit declines. And we're already seeing some cities. We've seen San Francisco and San Jose and Seattle reach declines of double digits as far as just median sales price is concerned. And I do believe we're going to see many more, especially some of these pandemic boom towns like Phoenix, like Boise, like Austin, Texas, like Las Vegas. A lot of these cities are going to reach the point of double-digit house price declines. Now, with that said, there were also 50 markets they found that are either staying neutral or they're still on the rise currently. So let's take a look at what's going on with that. If we see the interactive map over here, you can see the majority over here is hovering around Florida. A lot of the Florida towns are actually still doing pretty good. You got Tallahassee, you got Orlando, you got Daytona Beach, you got Fort Myers. So a lot of the Florida cities are doing well. You got South Carolina's got a few cities here. You got North Carolina and Ohio over here as well. Cities like Cleveland, Ohio. You got cities like Louisville. And what you're going to find is that for the most part, the cities that are still staying neutral or going up, for the most part, with a few exceptions, are the lower cost areas to live, because at the crux of this, again, it's an affordability issue. So the places that are more affordable are going to see less of an effect as far as house price declines taking place. Now, speaking of affordability, everyone's trying to survive right now with inflation going on, and the latest inflation numbers recently came out for the month of August, showing an increase of inflation of 8.3% year over year. Now, this is bad news because it came in much higher than expected. We were expecting an 8.1% reading, so although it's down from 8.5% in July, down to 8.3%, the reality is month over month, if you look from July to August, we're really at a 0.1% increase. Now, 0.1% month over month doesn't sound like the end of the world, but in reality, you have to take into account that we're seeing a slight increase in inflation whilst we're seeing gas prices down 10.6% month over month. And even if you go to the previous month, gas prices are down 7.7% month over month. So gas prices, you have to understand, they play a huge part in our overall economy, and as such, it plays a huge part in our inflation numbers. Now, you also have to understand that the administration has been releasing 1 million barrels a day of our strategic oil reserves. Now, that has an effect because it artificially brings down gas prices, and that's why they've been doing that, to kind of afford some immediate relief to the average American. The problem with this is, as we're seeing a 7.7% decline month over month and then a 10.6% decline month over month on gas prices, we're still seeing the overall inflation up 0.1%, and that's why it's so bad. So actual core inflation, which core inflation is basically the cost of goods and services, not counting food or energy costs, we saw that go up from 5.9% year over year to 6.3%. And there's estimates that if you had gas around 0% increase, we'd be over in the mid-9s at this point in our overall inflation numbers. Now, again, we care about inflation because the Fed has been talking tremendously about how their number one goal right now is to fight this inflation by hiking interest rates, offloading their balance sheets until we get to a point where inflation reaches a 2% level again. Well, at this rate, that process looks like it could be at least a couple of years for us to reach that goal. And if that's the case, that's why I'm predicting that we're going to see higher mortgage rates in the months ahead. So we're currently sitting around the 6% level as far as mortgage rates concerned, but if we get to the point where we're at 7% mortgage rates, or God forbid even 8% mortgage rates, well, at that point we're going to start to see affordability issues across the nation, even in these low-cost cities that really haven't felt the full effects of these higher mortgage rates so far. So overall, this article was a great read. I felt like it really confirmed what we've known is taking place all along, but ultimately, there's still a lot of people that don't believe that we're heading towards prices declining nationwide across the housing market, and ultimately, based on what the Federal Reserve plans to do and the way that inflation is seeming like a tougher battle to fight than initially expected, I do think we are going to continue to see more of a housing correction taking place than we've already seen. So with that said, I hope you guys enjoyed today's video, and if you did, do me a favor and support the channel by smashing that like button, and if you haven't already done so, definitely subscribe and hit that notification bell to watch more content like this. Also, let me know your thoughts in the comments below, and I'll do my best to get back to you. Finally, follow me on Instagram and TikTok at The Out of State Investor, and if you enjoyed this video, I'm going to highly recommend checking out one of these two videos over here. And with that said, I'll see you guys on the next one.